Um, Good afternoon, everybody. I know some of you have been patient here on the call. Just want to welcome you to another edition of the Legends update for us for our region. Dave Lockard and his team from CBRE do a great job. Kurt and Marianne aren't on the call with us today, but they're always, the three of them are doing a great job. And we really appreciate the surveys and information they're providing for us for this call and for us throughout these times. So a few announcements, and I'll turn it over to Dave just from the GC&KA. First, as always, I want to thank our diamond sponsors. We are very blessed to have had these the last 3 years. Royal Finish, Sherwin-Williams, Red Path, PPG Paints, Pinnacle Paving, Court, Apartments.com, and Contractors Inc. 8 of them. We really appreciate all you're doing, and I'm so proud to say that now for the 4th year, Royal Finish will be our first one that's already committed to 2021 for being a diamond sponsor. So thanks to Mark Arnold and Royal Finish for being there for us already for 21. So I really appreciate that. So we are doing our first in-person meeting. September 28th, we're having our fall golf outing at Oasis Country Club. So it's going to be a little bit different format. There won't be a check-in stand. You'll go right to your carts with your groups, but we are doing our first in-person event on September 28th at Oasis. We are going to have a virtual general membership meeting on September 15th at 1 o'clock, slightly different format. It'll be in the afternoon. It's going to be a 1-hour GMM. We'll still have kind of a committee updates from all of our committees that continue to work during this time. But also we're gonna have a guest speaker, a national speaker, Romel Anakin will be speaking. It's a $25 event. We'll have some mingling, some gifts, and some committee updates, and just kind of our first kind of get together in that format. So look forward to that and get some information on that for September 15th. Next 2 things I want to talk about on an amazing historic kind of levels. Bob Walkie, president of Town Properties, and Jeff March, CEO of BRG. Bob is the chair of the Night Out Committee. Jeff is the head of the outreach this year. And the 2 of them in their group has raised over $200,000 for the Night Out. That's significantly higher than any year previously. And their goal continues to rise. And we just can't thank their hard work and their committee's work, but also it's just a testament to the commitment to the industry that our owners and primary members and associate members have to the industry. Both have contributed, both primaries and associates. That money will go for rent assistance, for food assistance, utilities for the families in need. And as always, we have our backpack event and such for the kids going back to school that we've had already and distributed. So I just can't thank you enough. And that's just historic numbers. And thanks to Bob and Jeff and their team for doing that. So we're very, very proud of that and that group and our 501(c)(3). And then lastly, I just want to give you an update. As most of you know, we've got a lawsuit filed against Governor Beshear for his mandate, executive order preventing evictions. And that moratorium that he has now since come out and changed to be a 30-day notice and then a notice period, which will take roughly 2 months to have that out, and then no late fees or any fees assessed through the end of December, really from March 6th until December 31st. We continue to process through that. we've had 3 mediation hearings. I must say a 9-hour mediation hearing in federal court that was a long day. We've had a couple since then. We have in-person testimony next week. So we have sent out letters and we have had some response to our request to help on that fund, the legal defense fund for that. So we've had some owners send in donations to that. Really appreciate that. So we're continuing that. That's the efforts to make sure that we can go through and secure our units and get paid. It's not that we're the bad landlords. We've done a great job trying to get assistance, and our rental assistance partners have been just fantastic. The Free Store has been amazing to our residents and others, so we thank to that. But we do want to have that option, that flexibility, if we need to have that eviction filed for those residents that are just choosing not to respond. So that eviction is, or that lawsuit is continuing, and we hope to have an update within the next couple of weeks for you. We'll do that. So I will end on that. I will thank Dave again for his time and commitment to the association, and turn it over to you, Dave. Thank you.
Thank you, Don. Good afternoon, everyone. You know, Don, your mention of the golf outing at Oasis, and that reminded me that a month ago, Mark Franks reached out and confirmed our date in February for the upcoming State of the Industry at Oasis. But I forgot to ask at that time if the event would be held indoors or outdoors. I guess that'll be a TBD as the date approaches. I'm pretty sure we'll have the event, but yeah, we'll let you know if you need to dress in your parkas and mufflers for the event. But thanks everyone for taking the time to join us this afternoon. Thanks, Don, Mark, association staff, for the opportunity to come in and present our investor sentiment survey findings. Some of you that have been on these calls in prior months, I think this is the third one we've had. We instituted this survey back in April, just as a result of conversations we were having with clients and the amount of uncertainty in the world as COVID, reared its ugly head and our world became dramatically disrupted. We wanted to at least have a benchmark and gauge the impact both financially and let's call it mentally and emotionally on our industry. So thanks to everyone who's been I know a number of these surveys have come out. Our appreciation to those who have taken the time to share their sentiments and their results with us so we can present these to you this afternoon. You should see on your screen, we have the survey result, the document that we just distributed widely actually this morning. So these are consistent questions over the past few months as we start to benchmark one month against the other to gauge the shifting mood in the industry. First page, you can see, it talks about leasing and maintenance practices. So what we see today, most owners, I would say generally, based on the results, have told us we're back to business as usual in the leasing offices. In fact, I think the results, and I'm going to share some of the information we also received anecdotally that maybe is not displayed in the document itself, but the sentiment is we're back to the new normal. And part of this is office hours in some cases are being adjusted or adapted because more owners and offices are going to what we call by appointment, less walk-in traffic, modifying hours in some fashion. There's also, with virtual tours and video tours, I would say in general, more pre-screening or pre-qualification on the part of the resident. They've been able to look at video perhaps and make a decision. Most of the traffic that's coming through the door is perhaps more in tune or more qualified than it had been 6 or 12 months ago. But generally speaking, offices are back to normal. Maintenance practices are back to normal as well. We're using air quotes though, because we have the new normal relative to maintenance practices as there enhanced access, enhanced cleaning procedures, making sure that staff are in PPE where possible at all to have the resident out of the unit when the repair is being completed. Those are now, I would describe these as the new standards in maintenance practices and interacting with residents in the post-COVID world. So 68% are doing additional cleaning, 86% they're doing them as necessary while wearing masks and gloves. Frankly, the other 14% ought to be wearing masks and gloves also, but they'll figure that out soon enough. Okay, the on-site staff hours. Have you adjusted staff hours in the office? Again, we get back to, we're back to that new normal, if you will. The adjustments that are occurring, a lot more virtuality, a lot more, options for the resident to actually see the property, see the unit without first accessing the unit. So I think that's something that's not going away. Sometimes you have these paradigm shifts or these, I don't want to call it cataclysmic, but disruptive events that would, I tell you, they have a tendency to accelerate trends that were already underway in the industry, and that's exactly what we're seeing here. How about COVID-19 diagnoses? How are you handling those? Are you asking residents to communicate positive diagnosis? Which is really interesting. I found this result fascinating. Back in June, 50% of owners said we want our residents communicating to us a positive diagnosis. Well, I guess the world's become a little bit inured to what we're experiencing, because now that number has dropped to less than a third. Only 1 out of 3 owners are asking residents to disclose a positive COVID diagnosis. I just found that an interesting trend. I'm not sure where that's going to lead, but it actually went counter to the number I would have expected to see in this survey result. Now let's talk about a number that, I mean, we've all been talking about since March. Back in the second half of March, when the world began to shut down, had numerous conversations from probably March 15th to March 31st, and really those were the genesis. These questions were the genesis of this survey. What do you think delinquency is going to look like in April when millions of people are losing their job every day? And that question, it rattled around in everyone's head. What's April going to look like? I don't even want to think about May or June, but let's just talk about April. And if I'm running typically less than a 1% vacancy in my normal run rate in January, February, March, what's April going to look like? Could it be 5? Could it be 10? Could it even be 15%? And what would that look like if this lasted for 3 months, 6 months, 9 months? So you start to, I don't want to call them doomsday, the sky is falling scenarios, but let's just say it's prudent to stress test your portfolio. And that stress testing, that spreadsheet exercise, was going on repeatedly throughout the region just because of the level of uncertainty. So our team really wanted to congregate, aggregate, and drill down on this topic, and this is really the genesis of the survey. What is delinquency going to look like? So what was your July delinquency? We asked a few weeks ago. How did July turn out? So compared to pre-COVID, how was your July delinquency as a percent? And well, actually 41% reported the same level of delinquency. Their balance, 59%, had something higher. And I would tell you that, you can see from the bar graph, the predominance was somewhere by, higher, by somewhere in the neighborhood of less than 5%. So there's been some erosion in collections, but I think nowhere near as bad as we expected back in March. And it's certainly a result, I would call it a direct result of CARES Act stimulus, cushioning that $1 trillion, cushioning the shock wave of COVID as it rippled through the economy. And we're now looking at, is there going to be a CARES Act 2? That's for another discussion. But let's roll to August, because the expiration of the CARES Act at the end of July, so we wonder, what is August going to look like? So while we had 59% back in July said vacancy was higher than pre-COVID, we now have 68% saying we're higher than pre-COVID in terms of delinquency. So we are seeing some evidence in August, a notable shift from 59 to 68%, softening of collections with the expiration of some of the subsidy that's been coming forward from the federal government. We're going to continue to monitor these numbers closely over the next few months. And at the risk of repeating myself, what I've said the last few months, the common refrain from owners has been, okay, we've managed to, shield from this shock wave. We managed to deal with this, but it's required a lot of heavy lifting at the site level and a lot more hands-on working resident with the site staff, our senior leadership with the site staff, working on through certain situations, certain circumstances, and developing reasonable, rational, equitable policies in terms of dealing with residents' inability to pay due to circumstances beyond their control, loss, wholesale loss, job losses, economic uncertainty brought on by COVID, and also distinguishing those between, frankly, people who are just ghosting the system and taking advantage of certain circumstances that may have arisen. So it's really required a lot of heavy lifting on the part of the operations teams. Excuse me while I have a drink. So kudos to those at the properties we've been to, we've had a lot of discussions with owners, we have a lot of discussions with regional managers, with site managers, and they're generally telling us, look, it hasn't been as bad as we expected in March. We don't know what the future holds, but we feel better equipped to deal with whatever may come down the road. And we're also able to pivot or move on a dime depending on circumstances, but we want to keep our good residents where possible. Don mentioned earlier in his opening remarks, discussions about subsidy and the most capable, thoughtful owners, the most professional have said, look, here we're going to use resources that can be the apartment association outreach, can be the Free Store Food Bank, can be St. Vincent de Paul, can be various church or community agencies offering subsidy or rental assistance, taking advantage of those, because those rainy day funds that were set aside, well, we're in a rainy day. So that they're being put to use, and we expect that to continue probably for some period of time. How about lease renewals? Question 8, lease renewals. Well, 77% are saying they're renewing at an increased rental rate, which frankly, if you'd have asked anyone back in April, do you think you'll be renewing in August at an increased rate? The general sentiment was, are you kidding me? No way. So we have managed to kind of sail through this with quite a few bumps along the way, but it hasn't been a complete tsunami. Which then ties into our next question. Now we get into some, what are you telling us from an investment standpoint? What's your mood? What's your sentiment in the environment today? Well, there were quite a few owners back in April who said, what are we looking for rent growth in this coming year, in 2020, year 2020? We're not looking at any rent growth, but we expect, based on what we see today, probably going to be some heavy concessioning and discounting. We're probably going to have a significant erosion in rents. And actually, as we sit today, no one is expecting to have anything less than the lowest point being neutral rent growth, but no one is expecting negative rent growth in 2020. In fact, 3/4 are expecting rent growth somewhere between 1% and 3%, which is probably less than they modeled back in January, but certainly given the circumstances, not bad for this year, because I think we'd all agree 2020 has been a little bit of a doozy. There's been a lot going on in 2020. Yeah, a lot going on. By the way, does anyone know when that hurricane's supposed to come through soon? Because it's going to be a little wet here this weekend. 2021 and 2022. Now the outlook has gotten brighter, sunnier, and rosier for those 2 years in terms of rent forecast and rent growth outlook. You can see the growth, expectations. The August respondents said, or even better rent growth than we would have anticipated last month. You can see that the blue bar outpacing the green bar. So there's positive sentiment there. And same holds true for 2022. Investor sentiment, mood relative to rent growth is increasing. question number 10. This is going to be a real disappointment to those of you who called me in April saying, Dave, I'm looking for distressed deals. Can I get the deeply discounted deals that are going to be popping up any minute? Because what has happened is pricing is not eroding. Owner expectations and buyer expectations, there's not a big as gap as you would have expected. The telltale sign is here. We had let's call it an inflection point. If you're looking on the screen, where the dark green bar crossed over the light green bar, that's what, that means that more owners expecting to pay. Same buyers, same pricing. Sellers are expecting same pricing as pre-COVID, okay? More are expecting that. And you can see from the purple bar, believe it or not, whoa, given the circumstances and facts set in the economy, in the markets today, we wouldn't be surprised to pay a higher price than we would have back in January. I mean, that was, and notice that purple bar at the bottom for 4 months, flat, flat, flat. And oops, now that things are starting to get in the market, starting to be bid on, the reality setting in that multifamily is a pretty good home for investment capital. There's no shortage of investment capital. In fact, 10% are expecting actually to pay more than pre-COVID pricing. And that's also moving down to number 11. Here's why. I mean, the return requirements, a lot of investors are saying we're going to live with the same return requirements we would have back in January. When you throw those return requirements on, frankly, very low cost debt, you start to see cap rates that are as low as, or in some cases even lower than they were a year ago. If that, even with the increased risk in the market, investors taking a mid to long-term view have said, when we come out of this, and we will come out of this COVID circumstance at some point in the future, where does the capital want to find a home? Where does it want to rest? The predominant sentiments right now are, and this should hold true for the foreseeable future, predominant sentiments are multifamily and warehouse/industrial. Those are the two food groups where you're going to see, and you already are seeing, an abundance of capital seeking a home. Cap rates, they're going to fall. These cap rate conclusions, okay, this is where you're going to see cap rates, I would say somewhat, I would expect them to be consistent with the comments I made earlier relative to return requirements remaining constant. And we saw an expectation, and I'm going to give this to you anecdotally because we asked the question relative to September. But then I have a lot more information that I'm going to share beyond that. September, you started to see more investors saying, hey, cap rates are going to be the same as they were pre-COVID, okay, as benchmarking January to September. But here, we're probably going to modify this question in the future. What's your expectation on cap rates for the coming year? Cap rates could be actually tighter in the fourth quarter of 2020 and into 2021 than they were even in 2019 and the first quarter of 2020. And that's a reflection. Well, let me just say that that's just not just my guesstimation or estimation. That's a sentiment that's shared by a wide number of investors and also shared by my peers at CBRE across the Midwest. We speak each Friday collectively for up to the minute market intel in these uncertain times. And the prevailing sentiment relative to cap rates is they are going to be at least constant compared to pre-COVID and could actually tighten. What you might see where the resultant being pricing consistent with pre-COVID pricing, because you may see a slight erosion in NOIs due to increased delinquency or additional operating costs related to COVID. You might see those decreases in LIs, but when you apply a tightened cap rate, you're going to end up roughly the same value that you would have pre-COVID. And that kind of holds true across all asset classes. Right now, the curves look in some level. There's some level of consistency, especially on the where we're saying they're going to be higher in September, but I'm going to tell you beyond that, they're going to go flat or lower. Debt quotes, well, the debt markets are still, they're, well, let me just give you a reference point. During the great financial crisis of 2008, 9, and 2010, we didn't really talk much about debt quotes because, frankly, no one was lending. There wasn't much to talk about in the debt quote world. The good news today is there are still debt sources, and our two biggest ones, Fannie Mae and Freddie Mac, still open for business, lending. Yes, perhaps with some constraints, some reserves, a little bit more caution than they were a year ago, but their windows are open. Banks are still lending, although, I think you have to probably look at more bank options than you would have in the past. And I would tell you across the banking world, the banks that we've talked to, there's not a consistent theme on how they're dealing with various loans, their willingness to make loans, their appetite for risk. What we're finding as a generality is in today's environment, the bigger the bank, the less appetite for risk. As you move down to medium-sized and smaller-sized banks, they're still, I think, more willing to be open for business at terms at or near where they were a year ago. Market disruption. I get this, how much longer is this market going to be disrupted? And frankly, we should have clarified this question. What do we mean by disruption? Because let's define disruption. And I don't think we've defined it well enough. There's operational disruption. Well, how long are we going to be disrupting operations? How long are we going to have difficulty, perhaps collecting rents? How long are we going to have to do forbearance agreements? How long are we going to have to be doing certain elements to keep our business moving along as it was? There's also economic disruption. How long has the economy disrupted? People out of work, high unemployment. How long will that go on? Who knows? And then capital markets disruption. The lending environment, the equity markets. How long will they remain, well, volatile or, in our estimation, disrupted? So we haven't segmented those questions, but let's just throw them all in the same bucket. It said, it feels a little more uncertain today than it did a year ago. Let's call it disrupted. How much longer is this going to go on, Dave? Well, at least half have said at least another 4 to 12 months. Given the responses here, at least 50, more than half said that. And actually, when you throw in the 29% who said, oh, for a year plus, you've got about 80% of the market saying, we expect things are not going to be quote unquote business as usual, at least for well into 2021 and maybe through 2021. So that's probably a good benchmark at this point to kind of wrap your head around. Hey, will everything be hunky-dory by Christmas? Maybe not. But there is light at the other end of the tunnel. We don't think it's an oncoming freight train. And as we've proven as an industry over the last 5 to 6 months, we have the capacity with everyone banding together, being creative, being thoughtful, that we're making our way through this, monumental and historic period. Now, so pick your ideal quarantine house. We had some tough questions here. It was a tie between porch swing, fishing pond, and fire pit. Pool, margarita, and little dog. Okay, those were the places that people want to pick their quarantine house. Frankly, I have none of the above at my house, so I've got to find one of those arrangements. I've been quarantining here in the home office. And then lastly, open comments from owners. What are you looking, what's your primary issue you're working to address? right now. And so comments were the gap between buyers and sellers in terms of expectations on pricing. That's at least mentally narrowed as we start to see people wrap their head around the new normal. All eyes are on Washington, what the next round of potential stimulus will look like. Stay tuned there. Try not to ride the roller coaster on that. I would tell you that we have a couple of brokers' opinions. Some might be mine, some might be Kurt, some might be Mary Ann's. We'll leave that to your imagination. But strategic discussions, they're continuing to pick up in the capital markets. There's more intentionality toward transacting relative, Labor Day compared to Memorial Day in terms of sentiment in the market. There's going to be more velocity, more activity after I would say, came out of that cold stop shock wave of April and May. Activity at all levels has picked up in the last 30 days. We're starting to have more conversation with owners about beating the rush to market and the relative unknowns and uncertainties revolving around November 3rd. The last little piece I would offer is if you're wondering when you might see a bit more product in the market, probably at some point after somebody whispers changes the capital gains. The next day you'll see quite a bit of product in the market if that were to occur. So thank you everyone for your time this afternoon, your participation. I wanted to complete this in my allotted time slot. Don, I hope I met my time slot.
Did a great job. Is there any outside questions outside of?
Yeah. Chat. Yeah. How do you send them in? You send them in chat? You just.
We haven't seen anybody in chat yet. Anybody on the call want to unmute and ask a question? That's a first. Thanks, Dave, for your commitment to doing this. I know it's takes a lot of time, and we appreciate everybody responding. It's great for us to have this kind of information to share, and we do a great job kind of in this market sharing of data as well. So thank you.
Thank you, Don.
Okay. If no other questions, it's a wrap, I guess.
Okay, well, we appreciate
anything
it.
else,
Thank
Dave? Dave, is there anything else you want to say?
I don't, other than to thank everyone who's participated in the survey and thank everyone who took the time to dial in today. And stay safe. Thank you.
Thank you. Have a good day, everybody.